Hello, everybody, and thank you for joining me today for this edition of our Life Insurance Awareness Month's webinar series. And this is on benefits of life insurance and business succession planning. We're going to provide helpful tools and tips to help your business owner clients plan for a successful transition. And again, thank you for joining me. I'm Steve Clemens, president of URL Insurance Group, and I look forward to going through this with you all. So our agenda is we're going to share some business succession statistics, review common small business life insurance needs and opportunities like buy, sell, key person, executive benefits, and tips and tools to use with your next business life insurance opportunity. So while you're watching this, we do have some handouts that you can go and download while we're going through this presentation. We have a couple nice one-pagers on buy, sell, key person, and executive benefits that you can use to get more information as well as to provide your clients. And I'll share a couple anecdotes and over our 40 years at URL. We've used all of these strategies within our own business, and it's helped us succeed through the years. So business succession statistics: 2.9 million businesses in the US are owned by individuals age 55 and above, with accounting for over 32 million employees, 1.3 trillion in payroll, and 6.5 trillion in revenue. 73% of privately held companies in the US plan to transition ownership in the next 10 years. Half of those surveyed plan to exit within the next 5 years. 70% of business owners prefer internal transfers, meaning they want to give it either to a key employee. Some are second generation in the business that will be taking that over. But the great majority, 7 of 10, want to do that with an internal transfer. And 54% aim to pass their business to the family members. But unfortunately, we have a very poor transition success rate, with 30% of family businesses surviving the transition from generation 1 to 2, with only 12% making it to the 3rd generation, and 3% making it to the 4th generation. And 70% of small businesses listed for sale fail to find a buyer. So that's a pretty big number when everyone thinks they're going to cash out, find a buyer, and move on. 70% of the time that doesn't happen. Retirement challenges: 20% of small business owners have nothing saved for retirement. 33% feel they will never retire. And 40% of small business owners rely on selling their business to fund retirement. But again, 7 in 10 fail to find that buyer. So many of you have, whether you're in life insurance, financial planning, employee benefits, property and casualty, you know your clients who are small business owners who are affected by this. So in nearly 2/3 of family businesses lack a documented buy-sell plan. So what does that do? That creates a lot of opportunity for us to really talk about business succession planning with our business owner clients. So some basic concepts. Here are some of the basic things we're going to cover today to go over and help you go out and meet with your next business owner client. Obviously, the business wants to protect against employee death. That's a key person life insurance policy opportunity. Businesses want to protect against employee departure. The job market, there's been a lot of bouncing around the last 5 years, and we want to keep our best employees in place and give them incentive to stay with the company. So that comes to areas like executive bonus, deferred comp, and we're going to focus on executive bonus here a little bit later. And then protect for the eventual transition through a buy-sell agreement. Again, all of these options are best funded with a life insurance policy, and very easy to do it and to present it to your clients. So positive impacts of having a succession plan: One, your customers have assurance. There's less of a chance of losing good clients and customers when you have an organized succession plan and can talk to your clients about that, especially if you're near retirement and your business owner clients are talking about maybe retiring and what's to happen with the business. Those other people who use those services are going to be interested in what's going to happen and how am I going to continue to work with this business in the future. It also creates employee assurance. Employees feel more secure in their career path forward if there is a succession plan in place. If there isn't, then they're really just they're rolling the dice out there with their careers. So it does create employee assurance when that there is a plan in place and it's communicated to the staff. Enhanced business value too. So for the business owner, by having that plan in place, specifically if they're going to go to market, that's going to enhance the value of their business and their valuation when they have that stability and foresight of planning. It also provides orderly transition of ownership. There's a clear process for selling the owner's shares and preventing disputes. Defined valuation eliminates, again, arguments over the business value, providing fair and agreed upon valued method. Liquidity provides a way to convert an owner's interest into cash, offering financial security for the exiting owner and their heirs. And especially if it's a family business, keeping the family and the staff happy. No business owners who are partners want to be in business with the deceased partner's spouse or children. So having that plan in place is key for the business owners and their clarity as well. So we do that with the buy-sell agreement. It's a legally binding contract. It can be very simple or it could be complex. It calls for the survivors to buy and your heirs to sell the business at an agreed upon price. As important as the agreement is, it only works when the purchaser has the cash to buy the business. So life insurance is the most cost-effective way to fund the agreement. So that is the best way to do it. Definitely, once we have the agreement in place, they want to certainly make sure that that agreement is funded with life insurance. Three common structures for buy-sell. The first and most popular today is the cross-purchase agreement. That's where each owner buys a part of the interest. Each owner buys insurance on every other owner to fund the purchase. You also have an entity purchase where the business itself buys the interest and the business buys the insurance, owns the insurance, and is beneficiary of that insurance. But after June 6, 2024, there was a Supreme Court ruling, Connolly versus U.S., where the Supreme Court ruled in favor of the IRS. And because this was an entity purchase buy sell, two brothers owned a company together. One brother passed away, had a life insurance policy. The ruling was in favor that the life insurance policy was included into the value of the business and therefore the value of the estate. So that business owner's estate owned roughly an additional $900,000 in estate taxes because it was set up in that fashion, and it was not. They didn't do the proper guidelines to follow to make that a tax-free exchange or not taxing the estate. So with that being said, it is truly important to review the buy-sell agreements with your clients. There has been a pretty seismic change in the environment in the last roughly year. The cross-purchase, it was said within that Connolly case that if this was a cross-purchase agreement, the funds would have flown through tax-free. So cross-purchase is kind of the way to go, just on a basic level for anytime you have multiple owners. That's the way we've been seeing these structured of recent. There's also one-way agreements. So you have one sole owner, an individual, usually a key employee, agrees to buy a sole owner's business. The buyer typically purchases life insurance, owns it, and is beneficiary and funds it themselves. So when these buy sells are put into place, we're the ones in the insurance world that are helping fund it through life insurance. You want to make sure that the businesses and the owners, attorneys are involved to be able to draft the agreement and make sure it aligns with the corporate documents, state laws, and operating agreements. Insurance professionals and financial advisors are going to help model succession scenarios, spot funding gaps, review the long-term goals of our clients, assist in structuring and providing the insurance to fund the agreement, while making sure the ownership and the beneficiary design is structured correctly on each policy. So if it's a cross purchase, then obviously each owner owns the other owner's policies, beneficiary of that policy as well. And you want to make sure that their CPA accountants are involved to evaluate the tax consequences for the business and the owners. They'll help navigate the tax impact on ownership transfers, life insurance proceeds, and potential estate and capital gains liabilities. Very important to have those all involved in the planning and building out of the buy-sell agreement. Planning and communication is certainly key to success. A fully funded buy-sell agreement that is fully communicated to family and staff can make for a smooth transition and alleviate delays, legal issues, disgruntled family members. And certainly don't let your client die without a plan in place. It could mean the end of the business your client worked a lifetime to grow and a significant reduction in the value of the estate. And again, no one wants to be in business with their partner's husband, wife, kids who've never been in the business before. That's just a messy situation. With buy-sells and buy-sell agreements, many of you who work with URL know, we're coming into our 40th year here at URL. We're a family business. I'm second generation in the business, as is my brother. Our father and his partner started the business in 1986. My father, Gary, his partner, Dick Bassiano, passed away in 1997, just within the first 10, 11 years of starting the business. A buy-sell agreement was in place then, helped keep the business going. When our father passed away years ago, a buy-sell agreement was in place. Everyone knew what it was. We communicated through it. It was funded properly, made a smooth transition for the business to move forward and for our mom to be happy and to be fully compensated for the shares of the business. So these are things that help businesses succeed. And again, you look at the statistics of companies that do not last from first to second to third generation. It's because many times of not planning for future events. So I'm going to use an example of a cross purchase here. We're going to look at a company, Bob and Jerry's Guitar World. All right. Bob is age 40, owns 50% of the company. Jerry is partner 45, owns 50% of the company. Very easy. We're setting a valuation of the company at $1 million. So for the funding of the buy-sell, being a cross-purchase buy-sell agreement, Bob's going to buy a life insurance policy on Jerry for $500,000. Bob's the owner and beneficiary of Jerry's policy. Now, Jerry's going to buy a life insurance policy on Bob for the same $500,000, where he owns the policy and is beneficiary of the policy. Life insurance, very simple. On the top screen, we're looking at Bob. Bob's has a good build, non-smoker, occasional marijuana use. He can be as good as a preferred non-nicotine user. And a $500,000 20-year term, taking him to age 60, would cost Jerry approximately $410 a year for that plan. If he had a 25-year term plan for $500,000, taking Bob to age 65, $576 a year that Jerry would pay for that policy. So Bob, on the other hand, has to purchase a policy on Jerry. Now, Jerry's a little overweight. He's a type 2 diabetic, non-smoker, again, occasional marijuana use. Not a problem, but we're probably looking at a standard rate with a substandard table 2 rating on average. So Bob's going to owe a little bit more money on Jerry. His premiums for 20 years, he's also a little older, would be $1,245 annually for a 20-year, $500,000. And a 25-year would be a little over $1,800 a year. So some may say it's a little unfair that one owner has to pay more than the other because it's obviously based on health of each individual. What some companies will do is they will bonus out or do a distribution to ownership to help pay for those. Now, obviously, there's a taxable consequence on any distribution made between from the ownership, but that way they are not coming too far out of pocket, and minimal tax on that distribution for the ownership for those life insurance policies. But again, they're personally paying these and doing that. Now, you can get more complex, get into permanent insurance with cash accumulation. We can help design those, but very basic needs here. The other thought is many times businesses are growing. So maybe this is a single store shop and that they grow and add another store and another store and another community. And now their valuation has grown from $1 million to $2 million, $3 million, $5 million. Well, they can always get more insurance as long as they're insurable to help fund that buy sell. Very easy to do. That's where you come in to help them with that. And that's why it's always good to review the buy sell every couple years to see if they still have the same need, more need, less need. Key employees in life insurance. Who's a key employee? Responsible for management decisions, highly compensated by the company, has significant impact on sales, has special rapport with customers and creditors. Losses from a key employee's death, loss of management skill and experience, disruption in sales or production, credit difficulties, expense and time of hiring and training a replacement. This is something else at URL Insurance Group that we've unfortunately had to go through. We had a death of a key employee here at URL years back who ran our Medicare division, Jerry Scalf. So some of you on the call may have known Jerry and worked with Jerry. Incredible individual. At a young age, he developed ALS and then eventually couldn't work and passed. At URL, because of his position at URL, being a vice president and being in charge of a department and all of these bullets here, a key person policy was in place for him. So upon his death, from a company standpoint, we would have a loss of time and expertise that we had to fill and rehire and do all of those things. So that is where that policy came into place. We're also able to provide some money to his children for a college fund and things of that nature. So that is something that was nice to have a policy in place to help us over that hump and also help his family in the same time. So key person life insurance, if the insured employee dies, the employer receives needed funds to help meet the financial obligations and train a replacement. Most insurance companies will consider up to 10 times the key person's annual income for evaluation method with underwriting. And if they're older, if they're age 60 plus, usually it's about 5x the key person's salary and annual income. So that is, if there's a higher need that is required than 10x or 5x, companies would like a good cover letter to explain that. We've seen that in special situations. We've seen where heads of churches, ministers have grown a huge congregation, but take a very little salary. And they're very dynamic and, are part of the growth of the church, and they need more than 10x a salary for that key person. So we've seen situations like that, developed a good cover letter to let underwriting know where the valuation is, and that always helps when we have those needs. Advantages of the key person life insurance: the death benefit provides money to offset any losses in sales and production, provides money to fund and hire talented replacement, a signing bonus, a talent search, things of that nature. Provide money to help fund the training of a replacement, external or internal. And while alive, the business would have access to cash value in the policy for loans and withdrawals. I mean, assuming that the policy is a permanent life insurance plan. Why it should be offered, and I highly suggest to anyone working with businesses that you talk about key person life insurances. Small businesses need it. Small businesses rarely think or know about this as an option for protection against unexpected loss. It shows your clients that you care about their business and the future of their business. It's very affordable, and it's another opportunity for you to add more lines of coverage to your services and helping your clients with insurance needs. You can offer these as well, depending on age and everything, with very limited underwriting, accelerated underwriting plans, making it hassle-free for the business as well as the key employee. So key person example, we're going to look at Phil here. Phil works at Bob and Jerry's Guitar World. Phil's a top salesman at the store. He accounts for 50% or more of the store's sales. He has relationships and played with most of the local bands, relationships with the guitar company, sales reps. Phil makes $100,000 a year in salary and bonus. And Bob and Jerry's Guitar World wants to purchase a key person policy on Phil because their broker mentioned it and talked about all the great details of it. First, the company has to get Phil's consent. So when you do an application, there's a consent form that helps for the tax-free, that will provide the tax-free death benefit paid to the business. The company applies for coverage, and the company is owner and beneficiary of that policy. So if we're just doing term, very low cost, Phil's 45, $250,000, $500,000, $1 million, however much they want to insure, up to 10x Phil's salary, could be anywhere. If you did $250,000, $355 a year to $1 million of coverage at under $1,200 a year. So you could be literally $1 a day and go up from there, or even less if they just wanted to do 1x Phil's salary. So very, very affordable way to do it. Looking at a 20-year term, taking Phil to approximately retirement age. If Phil moves on, leaves the company, obviously the company can cancel the policy at any time and stop those premiums. Another example, getting a little bit more benefit here, is a return of premium option. This is a 20-year, $500,000. Now, this is just over $3,000 a year, but there's cash value building up in this policy that the company can use. Also, if the policy is kept for a full 20 years, it's 100% refund back to the company, over $61,000 going back to the company. If Phil left the company in 10 years, the company could cash out and have over $19,000 of guaranteed cash coming back to the company at that time. And the company, if they really wanted to, they could transfer ownership to Phil. So it could be like a little benefit for Phil in the back end on retirement, saying, hey, we're going to transfer this over. There's $61,300 of cash value that will be coming back to you. Or if you look on the right-hand column, there's a paid-up life insurance benefit. So the company could say, hey, on retirement in 20 years, or in 20 years, you stick around, whenever you're retiring, we're going to provide you a paid-up life insurance policy. And that benefit, if it's in 20 years, is going to be $126,000, and that'll carry Phil to age 99. You won't have to pay a dime of premiums, and you'll have $126,000 of life insurance. If Phil was retiring, say at age 60 in 15 years, the company could transfer ownership and give him $91,000 of life insurance without a premium for the rest of his life. Or the company could say, hey, in 15 years, we want that money. It's $38,000. They can cash out at that time. And key person, another example, is looking at more of a company asset, again, like return to premium, but greater value. This is a 10-pay whole life policy with Cincinnati Life. I love this whole life policy. It's very simple. It's very For a 10-pay whole life, it's a good price. We're looking at Phil at $250,000, and it's $8,475 a year. But again, this is a company asset. This is building cash value. This is not just an expense on a balance sheet, but an asset. So the company has nearly the same cash value as premiums paid by year 8. If you notice, in year 8, the company's paid in $67,800, and there's guaranteed cash of $67,386. By year 10, they've paid up the policy $84,750 of premiums, and there's already over $91,000 of guaranteed cash value in that policy. And the longer it goes on, if Phil stayed 20 years, there's cash value of over $123,000 in that policy, again, that the company can use at any time, take a loan, a surrender of that, or just cash that out. So very nice benefit for the company if the company has some assets and money. If they want to look at it from a financial position of an asset over an expense, they can do that. So key person insurance is great for the company, but Phil may say, "Hey, I'm giving consent for you to do this for, on my demise. What's in it for me? I'm a great salesperson. I bring in all this money for the company. What's in it for me?" So the problem, Bob and Jerry's Guitar World has a dynamic sales director in Phil. He's frequently approached by recruiters and competitors like Guitar World. So the bigger nationals are coming after him, wanting to get him to work for them. The company wants to provide an incentive to ensure that Phil remains with the company through retirement. The loss of Phil could mean a real negative financial impact on the company. So an executive bonus using life insurance is a good solution. The employee receives a death benefit protection. There's tax-deferred cash accumulation potential, and generally a tax-free income stream. The benefits for the business: it incentivizes the employee retention. Premiums are paid by the business. They're tax deductible. They can be offered to select employees, so you can discriminate to which employees receive this benefit and do not. No IRS approval required, and it's very easy to administer and implement. So the employee gets the death benefit, an attractive compensation package, cash value of the policy tax deferred, and builds a generally tax-free retirement income stream, taking loans out of a policy, tax-free loans to fund and help fund a retirement. Employee is the owner of the policy and retains control of the policy, not the business. So this is an executive bonus for Phil. This is a case study provided by North American Company, and this is assuming that the company is paying $20,000 a year in premiums through age 65 for 20 years on an index universal life plan. We're looking at year 1 death benefit of $289,851. So if Phil were to die year 1, his family gets a $289,000 death benefit. In year 5, the death benefit is at $389,000, and by year 10, $489,000. Now, the very attractive piece, besides the company paying these premiums and providing this death benefit to Phil, is the cash and potential cash accumulation through an index universal life plan. And assuming current assumptions, current cost of insurance assumptions, the annual distributions through age 90, starting at age 65. So premiums paid through 20 years, no more premium payments. Phil could begin to start taking over $75,000 a year in tax-free loans out of the policy, starting at age 65 through age 90 in this design. So the total potential income from retirement to age 90 is over $1.973 million to Phil. That's a great incentive for him to stick around. And for the company, people are saying, wow, well, $20,000 is a lot over 20 years. This is a key employee. This is somebody who brings in a lot of value to the company. The Bob and Jerry's Guitar World, they may be providing Phil a bonus of roughly $20,000 a year in cash. Well, if they provide it through an executive bonus plan, the business gets a little bit of a tax deduction in that. And now it creates more stickiness for that employee, for Phil to stick around with the company because of the value on the back end, the life insurance throughout the policy, and the retirement income, all of those things. That's looking at a $20,000 annual bonus. Well, maybe they want to provide half cash, half life insurance and executive bonus. So they provide them 10,000 cash bonus and 10,000 in premiums into this type of plan. Well, then you're looking at roughly half of that retirement income. So instead of 75,000, you're at what, 37.5, 38,000 of every year into retirement instead of almost 2 million, roughly $1 million over the course of Phil's retirement. Still a really good deal. So something that, again, our team at URL can assist with if you are talking to business owners about executive bonus and how to do that with clients. So next, let's talk about a couple of the tools we have for success and to help you make these presentations with your clients. If you haven't been to URL's life insurance page on our website, we have a marketing page specific. So when you log into URL's website and you go under the life department, you'll see on the left-hand side of the screen, marketing tools. And here we have business life insurance marketing tools that are consumer friendly, that include professional customizable presentations, meaning you can put the company's business name on a cover letter or cover sheet with your contact information below for buy-sell agreements, all the business life insurance needs. We have one-pagers on buy-sell, key person, and executive benefit. And as a reminder, we have samples of those in the handout on this presentation today that you can download now. There's short videos, anywhere from 1 minute to 3 minutes long, that are, again, consumer friendly, that you can talk about, that you can show them on some of these different ideas. So if the business owner is not familiar with key person, executive benefits, buy-sells, where you have short videos that you can show them and give to them that will explain that. We have business fact finder tools there, case studies, sample letters that you can use to write to your business owner clients, that all you have to do is put their name and address and information in and your name at the bottom, and you're good to go. Social media posts, if you want to post to LinkedIn and to Facebook, there's already pre-approved social media posts, as well as specimen documents. So if a business wants a specimen cross purchase buy sell agreement canned, you can provide it to them. They can provide it to their attorneys and make any suggestions on any changes they want to make to that specimen document. In the Business Succession Resource Center, when you go to our website, Cincinnati Life, the one that you'll see for Cincinnati Life, there's a screenshot of it here. You can see a snapshot of some of these pieces that they have that I just went through. Legal & General Banner Life also has some nice resources that we give you a link to from our website, which includes some of the letters and social media posts and things like that. When you need help with your next case, you have a potential client, URL's Life Markets team is ready to assist in providing the materials, the quotes, and information so you can present and make that sale. And if you're not comfortable presenting or don't have the time because of the time of year, some of you are in Medicare right now and getting ready for AEP, or some of you are going through employee benefits and group health plan renewals with your clients and you just don't have the time to do it, not a problem. Our Orion referral team can take the lead, present and sell the insurance to your client, and provide you a nice referral fee. You just have to give us a nice warm introduction to do that. So getting started is easy. You got to identify your business owner clients. If you're meeting with a business owner on other lines, commercial, P&C, group benefits, anything, you can ask them one simple question to really spark the conversation. When was the last time you reviewed your buy-sell agreement? Because if it hasn't been between now and June 6th of last year, there might be an opportunity there just based on that Supreme Court ruling that they need to review that or maybe even revise it with their attorney. And it might give you an opportunity to provide funding for that buy-sell agreement. And they may not have a buy-sell agreement. So 2/3 of all family businesses do not. So there's a great opportunity for you to talk about that and then talk about that piece of it, your key person, your executive bonus. So once you establish that, you can set up a meeting with the owner and HR if they have HR involved to discuss business insurance needs and solutions. And certainly tap into URL for help and use our expertise and marketing tools in your presentation. We're here to help and we're happy to do it. And again, if you're going to refer it to URL, all we really want is a warm introduction to let when you talk to that business owner that we're an extension of your services, and we're going to give them a call at a time set, and we'll be happy to go ahead and do that for you. With that, I appreciate the business and the time, and I hope this is very helpful for you to go out and to talk to your next client or your business owner clients to talk about business succession planning, buy-sells, key persons, executive bonuses, and things of that nature. With that, I'm going to end the presentation, and if you do have any questions, I'll be happy to field a couple of those before we head off. Thank you.